sure by now you've heard about the 2018 tax changes. You've heard about the higher standard deduction, and you've heard that most people are not going to itemize. What are some things you can do in 2018 to help you save some taxes over the long run? Today, I am going to talk about multi-year tax planning issues. Today, we're going to talk about multi-year tax planning. Actually, this is the best type of tax planning because it doesn't take into effect how much taxes you can save today, but it tries to look into the future and determines how much taxes you can save today and next year and the year after, obviously using some projections. The further off you go, the harder it is to plan. So I don't recommend when you're doing multi-year tax planning issues, you go more than 2 years unless you're doing retirement planning. That's the only time I think you should go further than 2 years because nobody knows what's going to happen next year, talk less of 10 years from today. You all know how politics changes every time. So tax planning is the best way to minimize your taxes because it causes you to sit down and think about what you plan to make, what you plan to spend, and when is the best time to make it or spend it where you can pay the least amount of taxes. To have a multi-year tax plan, you actually need to have a budget because how else are you going to be effective in planning this? Tax planning is very, very helpful because over the long run, it's the best way to minimize taxes. Okay, the first multi-year tax planning issue I'd like to talk about is charitable donations. Let's say you're a married taxpayer and you file jointly. You donate $24,000 every year. Obviously, if you put the $24,000 and you have no other deduction, then you still get the standard because that's what your standard is a $24,000. So in this case, it might be better for you to put off making a $24,000 donation in 1 year and donating the next year so you get the itemized deduction every other year, which increases your deductions and decreases your tax liability. So here's exactly the same situation here. The only difference is rather than doing $24,000 in year 1 and year 2, they've done $48,000 in year 2. So based on that information, you can see in year 2, their tax liability is $49,972 versus it still being, let's say nothing changed and no adjustment for inflation versus paying the $63,412. So by doing this multi-year tax planning, they're saving $13,440. The next multi-year planning issue I'd like to talk about is meals and entertainment. This actually goes hand in hand with charitable donations. You may or may not have heard that entertainment expenses are no longer deductible. It used to be 50% of meals and entertainment were deductible, but going forward, entertainment is no longer deductible. So for example, let's say you take a client to a meal and afterwards go play a game of golf. The meal portion of your outing is deductible, but the golf outing is not deductible. So a business owner who has $45,000 in meal expenses and $10,000 in entertainment expenses previously would have been able to deduct $27,500, but now they can only deduct $22,500. So here's the multi-year tax planning issue. What if, rather than taking your client to events like golf, what if you took them to events sponsored by charity? That way you get a charitable deduction. And then you can use this as part of your multi-year charity deduction tax planning. Every other year you get this higher deduction. You get to support a cause you believe in and at the same time get a tax deduction. Just keep in mind that when you go to these events, not 100% of what you pay is deductible. Some portion of it would be cost of your meals and things like that, which are not deductible. And then the portion over that is what you can deduct. But it's better than zero. You get support a cause, get a tax deduction, plan it right. That year you might actually need all the deduction you need. So this is why multi-year tax planning is important because you can sit down, look at your strategy. So if taking your clients out is part of your networking, just figure out, okay, maybe this year I do this in networking. Maybe you just take them out for meals, and next year I do charity. That's something to think about as you plan your marketing plan, your marketing strategy for the year. Another multi-year tax planning issue is retirement planning. Now, this is one I take very seriously. And why do I do so? As a sole proprietor or an S Corp, single owner of an S Corp, the chances of you selling your business once you're done is very, very low. So what happens? Are you going to just depend on Social Security? We know that the amount you're going to get from Social Security is not going to be enough to sustain you. So you really do have to have a plan for when you're done running your business. Either you work on making your business sellable, or you work on building a good retirement nest egg. So here we're seeing an example of an entrepreneur making $50,000 in wages and $150,000 in income. Without the retirement plan, they're donating the max they can, which is $5,500 for both the taxpayer and spouse, so which is $11,000. Without the deduction, they get to pay almost $20,000 in taxes. With the deduction, it goes down by $880. Not a huge savings by any means, but it's a lot better than nothing. But let us take a look here at what happens over time. That $11,000, let's say they still have 25 years till retirement, will grow up to $521,804 at retirement age. You know, if they did zero, they will have zero. And that's after taxes. The last multi-year tax planning issue I want to talk about is, should I make that purchase this year or next year? That's a question I hear a lot of, especially if it's the end of the year. The taxpayer is wondering like, okay, where's my greatest tax advantage? Should I just do it now and get a write-off now, or should I wait till next year? Well, you don't know unless you have a budget and you're doing multi-year tax planning. So you can see this, especially this in the period of fast growth. This entrepreneur right here is looking to rapidly grow the business. Here, taxable income in the prior year was $146,000. This year, they're expecting $426,000. So they're going to go up from a tax rate of 22% to 35%. If they have large purchase to make, what year you think they'll have the better write-off? You got it, the next year. So if I were this taxpayer, I will wait till next year to buy it because I'm expecting lots of income. So I need lots of write-off to make that income lower. So I will wait when I have the higher tax rate so I get more of the tax savings. If you're interested in this Excel file, you can download it by clicking the link below. But in the meantime, just let me know what you'd like me to talk about next. Just leave your comment down if there's any issue that's bothering you that you'd like to see me make a video on. Go ahead and leave a comment for me. Also, if you like the content, be sure to subscribe so you get an alert when a new video is posted. And if there's any general comment you have, how I can improve things, go ahead and leave a comment. I look forward to reading your comments. Thank you.